So, hello, everybody, and welcome to Financing Co-Owned Properties with Coho BC, the collaborative home ownership initiative. We're really excited to have those of you who are able to be with us here tonight, and those of you who will be watching the video later. Most excitingly, we have two great speakers with us this evening. Ryan McKinley of Vancity Credit Union and Tyler McTaggart of Designer Capital, both with, like I'm on the co team, with experience and expertise in co-ownership and thinking creatively to find solutions for people in this housing market. Thank you, Ryan and Tyler, for being with us today.
Thank you.
So before we get too deep in, when we're talking about land and land stewardship and land ownership across our province, it is important to acknowledge that this land has been stewarded and owned by many different peoples and different nations across the province, across time. And we are really thankful for the work they did to give us such a beautiful and healthy province. And we take our roles as land stewards seriously and keep them and their ancestral and unceded connection to the land in mind throughout this. So what is Coho BC that brings us here today? Coho BC is an initiative that works to promote co-ownership as a viable and valuable housing option in British Columbia. We work to provide resources and professional support to assist groups going through the co-ownership process. We assist in the creation of these co-ownership groups through a dating pool, a chance to meet other like-minded individuals or families to create co-ownership buyer groups, and we work to facilitate the sale or resale of shared property interests to other potential buyers and partners. We are a collection, an affiliation of real estate agents like myself and others who are here today, lawyers, builders, financiers like Tyler and Ryan, architects, mediators, even matchmakers, all with experience and expertise in collective housing and co-ownership. So you don't have to reinvent the wheel. You can use the experts and make sure you're set up for success. Coho BC is not unique in trying to help solve the challenges of home ownership through co-ownership. There are actually initiatives across the globe in this, in Ontario, in the States, in Australia and New Zealand. And we're delighted to be one of the pioneers, though, in this growing field. So before I get too deep in, I'll give you a chance to meet some of the Coho pros who are here with you today. My name again is Noam Dolgan. I'm a real estate agent based out of Metro Vancouver who specializes, of course, in co-ownership and beyond that, generally in sustainable and green homes. And I like to just think real homes for real people and outside the box real estate thinking. Before real estate, I worked in environmental education, institutional greening, and community engagement. So coming to real estate, I really saw housing as the number one choice we make socially, environmentally, and of course, economically. And co-ownership was a clear pathway to make this viable, make this happen. And I also, they used to say, I'm not just the president, I'm also a client. I do co-own property with friends, oops, typo, and family. We have another of the other Coho professionals, the real estate agents with us today, because generally the real estate agents become your first line to talk about what is possible in your region, what's your budget, what goes into co-ownership, how is the structure of that. Often the other first line might be your financiers, and we'll get to them soon. But generally, if you're looking to make this happen, please reach out to one of the Coho pros in your area. So the next Coho pro I'd like you to meet is Brian Horowitz. Brian, if you could introduce yourself. He is
Hi,
our
everyone.
Mid-Island and Gulf Island specialist and a rural land use specialist.
Yeah, hi, everyone. Good to be here. We've got quite the panel here this evening. It's good to see. I work on Vancouver Island, based out of Cowichan Valley, supporting collaborations on the island, the Gulf Islands, and surrounding areas. Co-ownership's been a big part of my business from the day I became an agent. And before I became an agent on a personal level, I'm passionate about green building technologies and building community through all sorts of avenues, including real estate collaborations. And yeah, that's me in a nutshell. I'm here working hard as an agent. I got lots of fun stuff going on in my life. I'm a dad as well too, and it's good to be a part of this movement and finally turning talk into action, and supporting people who are ready to make it happen and assisting them appropriately and making the types of connections that are needed. And it's exciting to speak with Ryan and Tyler because that's a big connection that is needed throughout the process.
Thank you, Brian. We're also joined today by David Hale, the founder of Shared Home Ownership Victoria, which is part of the Coho network. And of course, he's in Victoria. David, thanks for being here.
Hey, thanks for putting it on, and thanks to Tyler and Ryan for being here tonight. Excited to hear what you both have to say. Yeah, the financing is really the front line. You have to know what you can afford, and I think it's a no-brainer with the prices that we are having to deal with these days that you can take two parties, put them together, and those parties can get their foot in the real estate door and start building some equity. So I think co-ownership is just a wave that's starting to happen, and excited to be part of it.
Wonderful. Thank you, David. And finally, we're joined as well by Scott Miller, our colleague in Nelson and the West Kootenays. Scott, thanks for being here today.
Thanks for having me. And thank you, everybody, for taking time out of your evening to join this wonderful panel and discuss these innovative options that are presented in the world today. I absolutely love working in these innovative spaces. I work in Nelson, BC, and I serve the West Kootenay area. I specialize in residential transactions, co-ownerships, and a multitude of different property types. If anyone's interested to learn about co-ownership on the buying or selling side, please don't hesitate to reach out.
Fantastic. So there's a long history of co-ownership in the province and around the world. Before 1966, there was no Strata Act. So if you wanted to own large portions of property or a small portion of a large piece of property, you had to co-own. And of course, historically, there were people owned as families and tribes. In the 60s and 70s, we saw ownership co-ops become popular. In the 90s, more recently, we've seen co-housing developing. And throughout all this time, we've certainly seen families buying together, investors buying together, timeshare, such fractional vacation ownerships as a model. So this is not a new concept. In fact, all stratified condos, duplexes, townhomes, these are all co-owned to some degree, right? The Strata Act helped make co-ownership streamlined it so you could have separate title to the pieces, but you still co-own the building, you co-own the land. And we're doing something similar now. We're trying to streamline the process for when there isn't strata title possibilities. Why we see people co-own? There are many draws that bring people in. The big ones is to build community, mutual support systems, know your neighbors, live next to family, right? To have better neighbors and better community. And of course, to save money or get more for the same amount of money, more yard, more space in the house, access to more resources. And it also allows people to live in otherwise unavailable locations, like quote unquote single family neighborhoods, which aren't zoned for stratification, although that is starting to change under some of the new zoning. We'll talk about multiplexes later and at a future event. Farmland, of course, where there's not strata opportunities, etc. So there's a lot of our province where you can't stratify, but you can have more than one living space on the property. So we like to say that co-ownership housing is better housing for less money. It's not just less money, it's also better housing where you get more and you get community and you live in wonderful places. And so it's a really great pathway to on all fronts. Who do we see co-own? Well, we see a lot of different groups co-owning at different stages and reasons in life. We see intergenerational families, right? Parents with their children and grandchildren living together in family compounds. We see individuals coming together, oftentimes in their 20s and 30s to first get into the market. And then we see it again a lot of times in the 40s, 50s, 60s, 70s. People who want to, have more community if they know they're not going to be living the traditional single family existence. We see young families partnering up to buy housing together, so two young families or a family with a single or couple friend, all sorts. Yeah, and I mentioned the others. And then we also see investors love this as a model to get into the market because they don't have to deal with tenants. That their tenant is you, the owner occupier, the best partner around. So it's really a hands-off, low-risk investment. And so we see people investing in their friends and their families' housing as well. What co-ownership looks like is really up to you. Right? A lot of people think I'm talking about communal living, sharing a house, a townhouse, or a condo, and all living together. And that is certainly one piece of the puzzle. We see groups doing that, the Golden Girls type model, or younger roommates. But we're also seeing a huge push, and the majority of our work is in co-ownership where there are private dwellings or suites or multiple homes on a property. So everyone has, their own living space and they share some common ground, some common space, the land as a whole, and certainly the title. We also see land-based businesses, farms and rentals coming together for co-ownership, and I've mentioned investment. And so how much to share is really up to you, right? Do you share land and ownership, but everyone is entirely separate and you really mimic a strata entirely with really set delineations? So this is my private yard, this is your private yard. Or do you go the exact opposite and you have complete collective home with shared kitchens and bathrooms and living spaces, or somewhere in between? And really the answer is whatever works for you and your partners. That's one of the beauties of this model, is that we can really tailor it to the needs of everybody at the table. Do you share collective space, yard, shed, garage, laundry? Do you share resources like tools, cars, gardening equipment, a hot tub? Do you do collective events, meals, and celebrations? Right? What kind of mutual supports do you commit to? Will you babysit for each other, shop for each other? Are you going to work on carpooling? There's really a lot of possibility in this world. And this is growingly popular, more popular than you might think, with 51% of Canadians in a poll last year, this is not 2 years ago, admitting they'd be open to co-ownership as a pathway to get into the real estate market. Higher with younger generations, probably because they don't see any other option for themselves. But as high as 34% in the boomer generation. And really every survey that comes out shows that it was 2 to 10%. Now it's growing to 13 to 25 to 50%. This is really, people are seeing this as a viable pathway for themselves. And that's really exciting to see this, falling into the normal cultural dialogue. So there's a lot more to talk about co-ownership, what goes into a legal agreement, what this looks like, what our housing types look like, what the process is like. There's a lot. And so you please do watch our What is Real Estate Co-Ownership and How Can It Work for You, for me, info session. Our next in-person one is May 13th, but we have a video of a past one that you were all sent in advance of this meeting, and you'll get it again in the follow-up. So please do go much more into depth about everything that's involved, because today we want to focus primarily on financing. That's why we're here today. So in general, when financing a co-owned property, all owners must be on the mortgage and each be held responsible for the full amount if there's a problem. And our financiers will talk about this in much more detail, how they create systems to make that work around for you and for the banks. Fortunately, partners are protected by their down payment, by their legal agreements, by the value of the land, and by the process that goes into co-owning. It's not just let's do it, let's get a mortgage and go. There's a whole process that goes into it to really protect you along the way. Co-ownership can also open up financial synergy or opportunities that wouldn't otherwise exist, right? If one person has a lot of cash, let's say a retiree with some equity, and another person can qualify really well for a mortgage, neither of those parties might be able to buy on their own, but together they can team up and actually get into the market. And so because of this growing trend, some specialty products do exist, like Vancity's mixer mortgage, which we'll talk about. More are being developed, and specialists like Tyler, are really looking at creative solutions for how to make this stuff happen. So we'll also touch on co-development, where co-ownership is a stage in the process towards a stratified product, and how you can make that work. And we can talk about, again, co-investment, where what does it mean if one party is living on the property and the other one isn't. But you didn't come here to hear me speak all evening. We really came to hear Ryan and Tyler. So thank you guys once again for being here. Our first speaker tonight is Ryan McKinley. Ryan will introduce himself, but he is a mortgage manager at Vancity Credit Union. And Vancity has really been a pioneer in a lot of spaces, but certainly in the space of co-ownership through their creation of the mixer mortgage product, and general their commitment to community and to creativity in finance. So Ryan, thank you so much for being here today, and the floor is yours.
Thank you very much. Let me get this going. I just want to make sure that, all right, can people see the screen? Okay,
Yes, we
good.
can.
So I'll just do a quick introduction first. My name is Ryan. I'm the Senior Mortgage Development Manager for Vancity. I have a kind of a unique role. I have multiple hats. I deal directly with clients, but I also work on the policy side, working on policies to address affordable housing and other things such as co-ownership. I manage our co-op portfolio, and I also work in co-housing as well. So a lot of different hats, and I do find it very it's interesting working on both sides of things, because when you start seeing something in the market and you start seeing issues, I can actually go and find policy solutions for them. So and I'll go into a little bit more of that in a minute. But I'll just start going through, and I'll try to hit everything at a fairly high level, and then answer any questions that people might have. No, also, he already brought this up, and his information is better than mine. We're referencing the same thing. This goes back to 2021 about people considering co-ownership. And, there are more stats, obviously, that Noam put forth. And just anecdotally, just based on prices alone, people are considering it more and more often. I'll tell you a little bit about the mixer mortgage itself, which we don't love the name. It will be renamed something soon. We're working on that, but so stay tuned. But basically, where it was born from is that we noticed, over a decade ago, that people were looking to co-own, and it was happening more and more often. Again, a lot of it born out of necessity. But we noticed people just kind of jumping into it because there wasn't really a process built around it. And people have always been able to co-own. You can go to any financial institution and get a mortgage with other people. But what we wanted to do is kind of build something to protect everyone involved, and so people can go into co-ownership with their eyes wide open and making sure that everyone's well protected. I work with a lot of co-ownership groups. There's friends, there's family, business partners. And I've seen kind of every different combination of people that are looking to do this. I'm going to just go over the kind of the basics of the kind of pillars of our co-ownership products, and it's kind of melding together a bunch of different things. First of all, I'll talk about the mortgage terms themselves. So as Noah mentioned, and we'll probably talk about later, mortgages in Canada are a joint and several liability, so everyone is responsible for all the financing that is attached to the property. But we can look to make sure that it's split up and it goes as smoothly as possible. The first thing that we do is you can split up your mortgage terms. So, if because everyone's coming into these things differently, some people might need more mortgage than other people. Some people want a variable term, some people want a fixed term, all those kinds of things. So we do have the ability to split up different mortgage terms. And so if there are, four individuals or two couples or what have you, and they want different payments and they want their payments coming from different financial institutions and they want to pay down their mortgage at a different rate, that is all available, and everyone can kind of keep track of the accounting then because they're completely they're separated. So that's the first thing. Two is the co-ownership agreement itself. They can be as complicated or as simple as you'd like them to be. We don't absolutely require you to get a co-ownership agreement, but we very much encourage it for some other items that we'll talk about in the next couple of slides. One of the other things that people don't necessarily think about are insurance considerations. You have to think that you are tying yourself to other people financially, and it is a very good time to make sure that if something were to happen to someone else in the group, whether loss of employment, a critical illness, or a disability, that the overall group isn't impacted. So this is again something that we can help with our own people, or you can go out to the market and find this yourself. We don't necessarily care where you get the insurance coverage as long as the entire group is aware of what insurance is available in the group, because that's not something normally people necessarily share, and so it's just important to know what risks there are and how you're protected. And Noah mentioned this as well, and I'll touch on this a couple of times tonight. One way that co-ownership is increasing, and I'm already seeing it, I'm kind of on the bleeding edge of it, is with the new zoning changes and people being able to develop their single family properties into up to 4 units, in some areas up to 6. And there are different people that are looking to do this. We just recently, I'm still piloting it right now. I'll launch it to the rest of Vancity in the next couple of months. But over the last year, knowing this was happening, I put together a policy to be able to finance these strata multiplexes. And so that's probably a different video altogether, but we do have the ability to do it now. And because of that, we're now seeing more co-ownership that is kind of transitory co-ownership, where either couples or individuals are coming together to buy a plot of land, develop it. So they would come together, it's all one land title, they would co-own it, and then they develop it, and then they can stratify it, and then we can pull the pieces apart again and assign the mortgages to the individual strata lots. So as you can imagine, there's a few moving pieces there, but that's kind of one group we're seeing. The other is family. There's a lot of where I think you're going to get a lot of uptake from people is you have parents that potentially have a lot of equity in their land. They now have kids and grandkids who can't afford to live anywhere near them. The parents want to age in place, and developing their property into a duplex, triplex, fourplex is a way that they can address all of those needs. And again, same with family. We can have everyone come in at once, develop the property, and then separate everyone off again. So just something to keep in mind. This is something that we give out to people, and you don't have to worry about reading it now. I can send it out to anyone who wants it. It's basically just a co-ownership checklist just to get the conversation started. And there's resources on Co-BC, of course, and all of the experts there. But when people are contemplating co-ownership, in addition to giving them the co-context and what have you, this is just kind of a thought starter. So people, when they're thinking about it, they can grab a bottle of wine and all get together in a group and kind of talk through some of these things. And it brings up some things that they might not have contemplated yet. So that's just a kind of a starting point for us. No, I know you'll recognize Richard, but just some examples of people and of situations that that co-ownership has existed in. This is Richard Bell. His firm is one of the experts on Co-host BC's website. He developed his property. This was before you could do a multiplex. This is all one land title into several units, and he has his mom, himself, his kids and grandkids all living there in different units. If you ever get a chance to hear Richard speak about it, it's honestly like it's been the kind of perfect combination for them. It allows their family to be together. It allows everyone to help each other out. Richard, being a lawyer, figured all the legal considerations to make sure all the kids were treated fairly and what have you. So it is it's a great story and one that that is being replicated. And then the last thing that I'll mention is this is just a screen grab from back to 2023 when when zoning rules we're just about to change. But as I mentioned, this is going to change Vancouver and the surrounding areas kind of landscape, and it's going to change how people potentially develop and own property. I think that might be the subject of another meeting altogether. But I just want to put that on the radar because that's another place where people are co-owning now. And I kind of whipped through that, but I stayed on time, so I'll leave it there for now, and then of course I can answer any questions when we get to that point.
All right. Well, thank you, Ryan, for that introduction to the product and to kind of how Vancity has been trying to pioneer in this space. And I'm sure there will be some follow-up questions on how to make this happen. Our next featured speaker is Tyler McTaggart of Designer Capital, and Tyler has really been helpful to a number of our clients trying to look for creative solutions to financing. And so I'll let Tyler introduce himself, a little bit about his company and about how they see pathways for co-owners.
Thank you so much, Noel. I'm joined by one of my team brokers, Alex. If he gets permission to turn his video camera on, he can do a quick wave. Alex is predominantly client-facing, and I have the role of CEO and manager as well as being client-facing. Before I jump in on me, Ryan, thank you so much for all that you're doing for policy and housing in BC. These are incredible programs. Thank you. So I'm going to share my screen, tell you a little bit about Designer Capital's group of companies. So similar to Ryan, I wear more than one hat. So Designer Capital is our mortgage company and it's our predominant business, but we also own a life insurance, disability, and critical illness brokerage because similar to what Ryan was talking about, insurance plays a key place in financing real estate. We also own a cybersecurity firm specializing in protecting the mortgage industry and mortgage brokers and other financial companies. So we take cybersecurity really serious. And one that I'm working with David Hale very closely with is my other company, Envision Developments. Envision Developments is a land use consulting company specializing in missing middle and SSMUH applications. And we design, manage, and consult on helping people bring their properties from basically a dream to fruition, helping them understand the zoning rules, the restrictions, and how to get product that's feasible over the line. So we can chat a little bit about that. Designer Capital is a mortgage brokerage, and my presentation today is just going to chat a little bit quickly on what a brokerage is versus working with an individual lender, and then some of the niches to doing this type of co-housing. So this slide here is about investment property financing because there's some other options where properties broken into residential properties, which are considered 4 units or less. Commercial investment properties, these are ones where there's a different way of evaluating them, and residential multifamily. Again, this is a recycled slide, so I'm going to flip through that one. But just chatting a little bit about the mortgage and financial landscape in Canada. So we've got kind of three areas that lenders are broken into. So first of all, there's a huge amount of choice and selection when selecting financing. And this first column are lenders that do direct to client distribution. So that's BMO, Vancity, RBC, CIBC, National Bank. Interior Savings has now been rebranded as Beam and a few others. But if you want a Vancity mortgage, you got to go and seek out Ryan or one of his counterparts and deal directly with a member of that organization, because they sell their mortgage products directly to consumers. This middle column, Scotia, TD, Manulife, HSBC, which sold to RBC, were banks. This middle column's credit unions, and then some limited access lenders. These ones had direct sales forces, so you can go and get a mortgage from Scotiabank directly, or you can get one through a broker. So this column is you can do it yourself or get them through a broker. And then this third column are small monoline lenders, finance companies, B lending, C lending, and private lending. These lenders require someone with a broker designation to collect your documents, represent you and the lender in the transaction to assist. And every single one of these lenders has different nuances to their rules. And the way we work at Designer Capital is we help clients to find lenders inside this side, or maybe giving them the advice that there's some options outside the broker channel, like maybe presenting you with a mixer mortgage and connecting you with Ryan as the best solution for you. Because we're not here trying to sell products, we're trying to provide advice in terms of where your file best fits. In a few minutes, I'm going to just show you the tool we use for that and in helping you right size the fit. There's some big differences between credit unions and banks, and this is a big pump up for Ryan and how the credit unions have really stood apart in BC. So the regulating bodies are different. So credit unions are typically provincially regulated, which would be BC FSA and BC. Banks are federally regulated, which is OSFI. And Canada is a member of another regulating body called the BIS, or the Basel BIS, and they came out with some new banking reforms called Basel III. The regulating bodies really indicate what rules the bank can work under in terms of coming up with their policies. And there's some big differences between what they're able to do provincially versus federally. And credit unions only lend to those who reside in their lending areas, normally where they have branches. I believe Vancity is BC-wide, everywhere in BC. And then banks lend across the country. As such, the rules are going to be different. Credit unions lending in a smaller geographical area, so they're facing potentially different and more regional risks than national lenders. Things like vacancy rates. The vacancy rates in BC are pretty low and have been for a long time. So the use of rental incomes tends to be much higher with BC credit unions than the big five banks, who have to come up with their policies all the way across Canada. So use and calculation of rental income, the requirement to stress test and mortgage qualification rates. Vancity has some great programs for this, Ryan. So if you had your hand in those too, kudos to you. Non-mortgage payment calculations. So I can walk through and chat a little bit about that. And maximum number of rentals. So those are some of them. We also do some advisory on whether you should buy property personally or hold in a holdco, and we have some things to just chat about on that. And commercial investment properties, sometimes a family might own something that has more than 5 units or 6 units, and there might be some things to walk in on that. This is just a walkthrough on that and that, but I'm going to jump over and I'm going to just share my tool with you now. So that's this one here. So this is the tool that we use on the daily. This is our financial planning tool. So this is a calculator that we can use to really illustrate co-ownership. And there's a lot of information on one page, so I'm just going to walk you through it. So over here on the far left-hand side, these are your debt ratios in bright green here. And we can customize these, but green means good and red means stop. So what we use this tool for is illustrating the power of one person versus two, of making changes. So when we're working with someone, we collect their information and we not only show them the power of one person versus the power of two, or if there were 2 couples or 3 couples, we can collect all of those information together. But we can also show the benefit of making changes in terms of maybe paying off a car payment or getting a new car and the impact. And then we can put in different lenders' policies at the top to talk about the financing amount. So down here, I've got income, over here debts, and up here property related info. So in this case, we're just illustrating one property with estimated property taxes of $5,000, a household heating of $175, and there was a rental income in here of $1,800 from, let's say, a rental suite. Some banks take 50% of that rent and add it back. Some banks take 80% and add it back. And that would allow someone to qualify for $1,043,000. Some banks allow 100% add back and don't count taxes and heat, and would qualify the same couple for $1,160,000. And Vancity, is, I still believe, a 90% offset. They do count the taxes and heat, and they would get the same person a mortgage of $1,197,000. So what this tool allows me to do is model rental usage. And then in this case, let's say we had one applicant and they were wanting to know what they qualified for. So I'm going to get rid of applicant 2 here. They would qualify if they bought a place with a suite at a bank, $515,000, not much you can get, with an $1,800 suite. So that's a non-starter. And we would go through and look at the different options all the way up to Vancity, which is the highest use. We get them up to a $700,000 mortgage, getting close, but not all the way there. And then so what we might look at is, this is where I may suggest looking at co-ownership, where instead of renting out a suite, looking at the ability to add another borrower to the application. Now, I've got different incomes here. In this case, I'm modeling the first person with 100 grand in 2023, 120 in 24. Their salary on their letter of employment says they make 95 grand. Well, if I use the letter of employment, it gives me a much lower qualification than if I say used a 2-year average, which is allowable. So when we're working with someone, we may collect more documents than you're used to providing, because we really want to look at you through multiple lenders' rules and regulations and policies to find you the best fit. But normally we can get away with using a 2-year average of someone's income when it's above their salary. An applicant 2, they're self-employed, they made $200,000 in 1 year, and in this case, this fictional person made $250,000 the other year, but they wrote it down to $80,000 and $105,000. Maybe they had a business with some employees or some other expenses. Normally lenders will take a 2-year average, and some lenders will take a 2-year average and gross it up by 15%. So looking at this, I got $216,000 in income, and this mortgage goes up to, without a suite, $1 million instead of one person with a suite getting less. Now I do need to add back someone's debt here. So we've got a pre-qualification of $945,000 without an income suite. So what this tool will allow me to do is answer, how much do you qualify for? And then if we look at the other person on their own as a standalone applicant, how much do they qualify for? Oh, $399,000. So one person at $399,000, the other person on their own at $453,000, but together co-owning a property, they qualify for $945,000, which is actually potentially getting them into something. So we can kind of model that. We do this same approach with people looking at co-owning with parents, with family. We can use this approach. If privacy is a concern, we can have one tab here for one applicant. We can have a different tab for the other applicant by copying it over, and then we can have a shared one that we don't share, that we talk about. So we're comfortable working with people in many ways. But this tool allows me to model what they qualify for. On this particular application, I'm noticing that there's some consumer debt that we might be able to do something with, say, part of the down payment. And we have some other tools to look at that. So we do down payment mapping, who owns it, where it is, where it's coming from. This is a credit planning tool where we can look at, hey, that mortgage, but you had some car payments, and looking at different options. In this case, this person's got a mortgage, line of credit, and a loan, and we're comparing it to doing a consolidation of the mortgage to show the difference between $4,900 payment and a $2,900 payment, which would allow them to cash flow. So we have some other tools here that we use. Someone's looking at refinancing or selling. We can look at those proceeds. So in terms of someone looking at co-ownership, we've really designed our process around being able to look at all the aspects of home ownership on these pieces and then show you what you qualify for. In terms of products, I'm going to go back to my slide here. Of these banks that we have, Vancity's product is very well suited for co-ownership, and it's a one-of-a-kind product in the market. But there are some products out there that kind of mirror it. Scotiabank, with a maximum of 2 borrowers on it, so 2 individual outside people, can break a mortgage into multiple people and have multiple payment structures, terms, and amortizations. And National Bank also has a product that can have multiple mortgage components. So if one person wanted to go fixed and another person wanted to go variable, there's some other products out there that we can help explore to look at what is the best fit. David and I have a presentation on Thursday to chat a little bit about multifamily. And I'll just jump out of this for a moment and chat with you a little bit about, is this the slide? So this is my Envision company, and we do development consulting and specializing in missing middle. And these are my partners in it. Xenia Vins, which is architect with XV Architecture, and Keith, who does the construction estimating. And what we do in this company is we look at missing middle applications, and we look at the total cost to build. So we look at the land, all of the soft costs and consultants, all the way down, all of the municipal fees to come out with cost of financing and the cost of building the unit to come up with the total cost, including a contingency to help model out and set expectations for what it costs. So in this case, this 4-plex unit, all in, including the land being built in Victoria, is going to cost $3,045,000. And then we look at, in this case, the people were going to sell it. So we looked at the front 3-bed, the back 3-bed. These are 3-bedroom units that they're building. They're all 1,300 square feet. The value of this is they're around $1 million each. And the lending analysis on this works out that the total cost of this project is $3,043,000. But the value is actually $3.7 million if they were to buy these new as resale. So if someone was to attempt to build it themselves, they would get in and split this 4 ways, $3,043,000, and they'd be building an equity of 22% above the cost. So in this case, this was modeled after this project here was, now this is a little bit small, so let me see if I can blow this in. So these are row houses all put on one lot that they were able to build. These are 2-story units, all with little backyard patios. And these are all entrance in the front, dining, living room, powder room, 1 bedroom. 1 bedroom on the main, and the upper is a master with a bedroom and a 3rd bathroom. So in these units, each person can get their own 3-bedroom, 3-bath unit and build in 22% equity in building it out. So those are some of the things that we do at Designer Capital is look at the planning of kind of more as an advisory to compare options. And we have access to a lot of lenders that are very open to entertaining applications with multiple borrowers and unrelated borrowers as well. That's what I had.
Fantastic. Thank you. That was very thorough. Before we get back to the presentation and then questions from the group, Ryan, do you want to talk a little bit about this multiplex building since we just were on that topic?
Yeah, for sure. So this has been a challenge. Through some other advocacy work, we kind of realized that these things were going to be, that these changes were going to be made. And so, but there was really not a product in the market for individuals to basically develop their properties into strata units. At least nothing that was very common out there. So we put that together now. These conversations tend to span a long periods of time because we're just at the infancy of this right now. And so, I mean, Tyler, you can probably say the same thing when people are looking at something that's this complex. You start with a conversation and it lasts for months or years because as soon as they start the construction, we're still following them around for another couple of years. But much like I won't show, my spreadsheet doesn't look quite as pretty as Tyler's does, but we have put together a process to be able to pretty quickly show exactly kind of what equity and what income is needed to support building these multiplexes. And Tyler did touch on this as well. At Vancity, we have a 90% rental offset. So if you're developing your single family home into let's say a fourplex, depending on where it is, you can have something like $12,000 a month of rental offset, which more or less brings the qualifying income down to a very reasonable level. So we're just kind of in its infancy right now. I plan to roll this out in the next couple of months. But anyone who is interested, we can take them on now. I do think that this is really, as I mentioned, going to change the landscape of kind of where we of our operating area. And until, I mean, people who know, and it's been reported in the media somewhat. But until people start seeing these things, actually materialize on their blocks, I think that's when it's really going to hit.
Fantastic. Thank you. A couple questions for me, and then we'll open the floor to our participants. What about larger groups? Is there a maximum number of co-owners that can be combined on these kind of applications? Is there a number you start having to move into commercial financing? Are there, you talked about insurance, Ryan, earlier. Are there insurance concerns? What happens if we're not just talking about 2 or 4 people, but we're talking about 6, 8, 10, 12?
Todd, do you want to take? I can take that one first, and then you can jump in.
Yeah, if you want to answer that from Vancity kind of perspective, I can kind of jump in and cover the rest.
Yeah, for sure. So I mean, as far as our technology is concerned right now, it's difficult to go beyond 8. I mean, that is just a technological barrier. So it's not impossible. The question really becomes, is this the right structure for you at that point? Because if people are coming in and out of this arrangement, you kind of have to start from scratch all over again. And so if someone's going out and someone's coming in, everyone has to it's a new application all over again. And it's not to say that we can't do that. We do it all the time. It's just it becomes quite complicated, and it might not be the best structure. The kind of caveat to that is when people are like I'm doing a multiplex build right now, and it is a family, so it's the parents and then 3 kids and their spouses. So there's 8 people, and they own and we put them for tax reasons. We put them all on title on the existing property. They're going to develop that into a fourplex, and then we'll split them apart. So it's really good to have visibility as to kind of what the end goal is, so we can first of all make sure that you get there, but also make sure that it is the right type of product. Most of the time, it's either maybe 2 couples or 3 or 4 individuals. It's not usually for the long term, more than 5 or 6 people. I'll pause there and let Tyler answer.
Awesome. Thanks, Ryan. Well, you hit it with technology limitations. So different banks have different technology limitations. Some have a maximum of 4 borrowers or applicants on a file. Great to know Vancity's 8. I didn't know that, but that's actually on the high end. So if you're getting it together in a larger group, it sounds like Vancity's got a distinct advantage there. Some lenders have limitations that might be 4, might be 6. in terms of the structure, as Ryan said, it really comes down to what's right. As a residential and commercial broker, we often would pivot these, looking at more borrowers than that, into something like into a holding company, so the shares could be held and transacted later. And some commercial financing might take a guarantee, personal guarantee of certain individuals, but not all of them if they have smaller amounts of shares or equity, so that people can be swapped in and out differently. So there's pros and cons to when you're getting up into those smaller fractions of ownership. Also, in terms of the asset itself, you get into use around, is this a primary residence anymore versus a secondary home when you get that many applicants, and it can get a little bit messy. But there's other structures that we could look at, where maybe splitting up an asset through a incorporated asset. We do that a lot with non-primary residence assets. Like if someone wanted to co-own a vacation property, is something that I commonly work with, where it's a popular resort community that families go to all the time, and they decide, hey, let's buy one of these units and share it. We might own that in a corporate name and be able to kind of structure the ownership a little bit differently.
Fantastic. Thank you. Now, looking at our audience, I know there's some people who want to know about tiny homes and tiny home communities. And I think, these co-ownership options are great, since generally you can't stratify a tiny home, and I assume can't finance individually or easily a tiny home on a pad. Can you talk a little bit about tiny home communities and what models there are, both traditionally and through these creative options?
I can start with that one again if you'd like. The tiny homes, it's there's so much nuance to it, because it really depends on the structure. If you're building a tiny home on land that's owned, then we can leverage the land to be able to finance that. There are some other ways of doing it. It really depends on where it is for us, and kind of what the structure is. I'm not sure, no, if you're talking about what type of ownership of the land would be, but maybe Tyler, you know better than I do, but as far as I know, there aren't a lot of financing options available in this space yet outside of the land loan, but I might be wrong.
I could jump in on this too. I'm here like grassroots community. I know a lot of people that live in tiny homes, and one thing that's come to my attention is just that homes on wheels are not allowed to permit full-time occupancy, period, in pretty much all of the districts that I'm involved with. So this whole definition of tiny home, I think it's brought a bit of a stigma to it. And I'm trying to change that on my end, is to just like small footprint homes, like a cabin, so to speak, something that's actually connected to foundation or tied down like a manufactured home. So I just wanted to throw that in there, because that's something that people need to understand, I think, and what could be a solution, as far as constructing a tiny home and then setting it down onto a permanent foundation, regarding making it authorized in the eyes of our municipalities. So that leads me to a question for you while we're on the topic, is your involvement with that, and lending on a tiny home that could potentially be on wheels, and you maybe not being connected to the municipalities, like us agents, and what types of considerations, if any, that you take on your end regarding the whole tiny home community that's kind of in this idealistic utopia vision that's hard to actualize because these homes are on wheels.
Ryan, do you want me to grab that one?
Go for it.
So when it's not permanently affixed to the land, you can't get a mortgage on it. So mortgage financing, you can finance them, but they're not mortgages. So mortgages needs to be registered at the land titles, and you can't register a tiny home on wheels at the land titles office. So it's not permanently fixed. So when it has wheels on it, you can get PPSA registration if it has a VIN number. So if it has, if it was purchased as like a mobile home or something like that, there's registration. It can be registered with PPSA, which is the People and Property Search Authority. And you can get a chattel loan agreement or chattel loan insurance through CMHC. So CMHC has a product called a clip loan, which is specifically loan insurance that protects a bank in the event of default over insuring an immovable object, but CMHC then requires proof that it's been permanently affixed to the land. So concrete pad, chained down, and the wheels removed, normally skirted. So we can get financing for tiny homes that were once movable on land. The problem is that, and you can get them in a rented park, or so if someone was to own the land and they were to come up with lease terms that were satisfactory, those lease terms could be run, or land use terms could be run by CMHC. And if CMHC was to approve it, which is the Canadian Mortgage and Housing Corporation, that you could get chattel loan insurance approval and you could finance the individual units on co-owned land or owned by one person deciding to use their land and rent it out to other people as chattel loans. Right now, when it comes to policy on these, it's very expensive for banks to come out with a policy. So they want to come out with something that can be used readily across multiple people because of the regulatory and legal costs in coming out with a policy. Because ultimately, not a lot of people in the finance industry are as nerdy as Ryan and I, who dive and love policy and go in and learn all of these nuances. And it really is just really hard to learn. So the people representing these financial institutions, they have to be easy for them to help get the products out to the consumer. And with tiny homes, there's a lot of risk to it. So that's why a lot of banks have just said no. If they're permanently affixed and they're smaller than 500 square feet, so different banks all have minimum square footage requirements and maximum number of dwellings per property. And we could do on a case-by-case basis, just searching, what bank is the best fit, who has the maximum number of small dwellings on the property. CMHC had a multifamily product called MLI Select that was being used for singular PIDs with 5 dwellings on it. It could be financed with commercial financing and some other things like that. But if they're movable, Brian, chattel financing is what we need. It's similar to, and you can get on a chattel, still get a 25-year amortization and mortgage rates. It just gets default insured. So there's a separate set of bureaucracy in terms of finding out the nuances on meeting the security regulations. So normally they want some proof that the electrical's up to code, that the economic life of the unit is 5 years longer than the lifespan of the loan. So 30 years of life to get a 25-year loan. The deals are a little bit complicated to put together. And so often what we would do is look at the whole picture, maybe putting financing just against the land and putting a single structure that meets a bank's requirement to get maximum leverage. So for example, if someone was wanting to do a tiny home community and they were going to do movable, we might look at financing the land and the construction, and you can borrow up to 95%. If it's under 500,000, so if it's on the island and it's a cheaper piece of land, or 90% for values over $1 million, using CMHC insurance so that it's less equity, build the main home and reserve the extra capital for putting the pads and moving the tiny homes on place. So there's some different ways that we could look at structuring a loan like that, Brian.
Do they put charges on title ever? Like as far as like once like, as far as the process, that temporary financing, that chattel financing?
No, there would be, if it's owned land, the chattel financing is financing on the unit itself. So it needs to have a registration, needs to meet the security regulations of chattel financing. There's a whole bunch of these tiny home kits that actually have gone and have VIN numbers and met the requirements of CMHC, modular construction, home kits that meet that chattel requirement.
If you're going to do something on your own, would you just kind of have to follow the municipality's building code type of thing if you're going to build your own structure as like owner builder?
No, I would say your own land, the first thing you'd want to do is consult with CMHC to make sure it complies. So to be a chattel, it needs to actually be permanently affixed but still movable. So on some reserve land, for example, there are tiny home communities that are being built with CMHC insurance. And the homes are actually built purposely, not just to municipal code, but they can be cut in half. So you can actually take a saw and cut down the middle of the roof line, and the home could be craned out in two separate pieces. And that meets the requirement of movable. They're still stick framed, they're permanently affixed to a foundation. So there are different ways around it. So if someone's wanting to contemplate that, getting some consultation with CMHC for their requirement, and then taking that to get something that complies with the municipality.
Great, thanks. And one last thing before we jump. This is really a hot topic. So in the area is CMHC. I'm going to presume they're looking at zoning because typically 99.9% of the zoning doesn't support these types of living setups unless it's grandfathered in. But speaking further to that, I'm specifically involved with a file that's got 8 units on the property. They're legal non-conforming, and CMHC won't support it, even though they're allowed to operate in their non-conforming status. They don't want to touch it because it's not in line with current zoning. So as far as that, I just wanted to see what your experience is with that. Like, do they really bring up the magnifying glass, and if the zoning won't allow for it, they just won't support it?
Well, there's other insurers outside of CMHC. CMHC, being Crown Corporation, probably needs to follow other municipalities' rules as a precedent set. Some of the other municipalities, some of the other insurers have more flexibility around non-conforming suites. So Sagen, as an example, is fine to use rent from non-conforming suites inside a home when CMHC wants legal suites and confirmation that they're legal. Some of the other insurers may be someone to go and talk to on that. 8 units is also not considered residential. So this falls into the role of commercial. So when it's 8 units on one title, it would be considered multifamily, and that would be 5 units or more. Anything more than 4 units. So falls into a different type of insurance altogether if insurance was in fact needed. But this one sounds like it's got a few more things that would pull it out of the box, Brian, than just the conforming status of it.
I get it.
So I think what this conversation has really done, of course, is proven why it's important to speak to the experts, right? Every situation is unique and different, and co-ownership is not as straightforward as a traditional real estate purchase, and we're really excited to have Ryan and Tyler, who clearly understand how to look at each file uniquely and figure out what works for it. With that in mind, I'll remind people in our audience that you can feel free to put questions in the chat, and in a few moments, I'll even allow you to share your video and ask your question directly. But to the topic of diversity in how we put together these files and what makes sense for everybody, we've talked about a traditional tenancy in common, all names on title type of structure. We've talked a little bit about corporations and creating a corporate structure. Can the two of you talk a little bit about leasehold structure, co-op structure, and maybe a blind trust beneficiary structure, and the pros and cons of these models?
Why don't you take this one, Ryan, with Vancity being the leader on co-ops?
Yeah, so I can go through a couple of these things. So co-ops, as No mentioned, they were around pre-stratification, and it was basically the answer to how you to split up a property without stratification. So it's all co-ops are equity co-ops, I should specify, are all on one land title. And we don't actually mortgage them. We don't register a mortgage. The security is actually the share certificate. So the corporation that owns the entire building and the land. They will issue shares that is equal to your holding of the property that's equal to your unit. And then we physically take the share certificate and we hold that as security. There's not a lot of financial institutions. I just did an interview a little while ago about this. There's not a lot of financial institutions out there that do it. Part of it is that it's not really a profitable venture. It's also more risky. The reason that we do it is because we are a co-op, so we wanted to support this, and we're one of the only ones left doing it, and so we want to make sure that people have options. So that's co-ops.
Ryan, can I just ask on that specifically? I've heard the critique that you have a list of co-ops from the 60s and 70s that you'll loan upon, but new co-ops that are formed today, it's very difficult to get that funding. Is that correct, or are there pathways for new co-ops to get into your funding system?
Yeah, I mean anything that meets our standards, like we will provide financing for co-ops. I think a lot of what we see now is that the co-ops that you might be referencing aren't necessarily the same kind of equity co-ops like that are kind of owned by a corporation rather than a cooperative. So it's kind of a little bit different. The actual cooperative financing outside of equity co-ops would be done through our community business team, but we can still very much do that. But usually now when co-ops, when people are contemplating it, co-ops turn into co-housing rather than equity co-ops, because it allows the stratification and separation of land titles. And so by and large, that's what we would see more often than not.
Okay, great. Continue with leasehold and beneficial
Um,
ownership.
Yeah, I can touch on leasehold. So we will look at many different types of leasehold. Like you might be aware of, like in kind of around Falls Creek, those are all leasehold by the city of Vancouver. Recently, they sent letters out to everyone, and they've given them options to increase the lease up another 20 years, because I believe that they all expire between 2036 and 2042 or something in there. And so we will provide financing on the city leases, and even we can even finance that extension as well. We have a way that we can do that. We will finance First Nations leases, university leases, and even we'll look at some private leases now as well. So we can look at kind of all of those different lease options.
Great, because I think private leases is one that a lot of these co-ownership groups, especially on rural lands, are looking at a way of creating these tiny home or other larger communities by creating 99 or 999-year leases on those parcels.
Yeah, as long as they're prepaid, but regardless of where what the lease is, as long as they're prepaid, it's something that we can look at. The private leases, I mean, they all take a level of due diligence and legal review because they're not really standardized. But again, we do have, and we're actually building a list right now of leaseholds that we've already reviewed, that so we don't have to keep going back for more legal reviews.
Right. And the question of creating a beneficial owner and a blind trust as a way to avoid joint and several liability. If you only need one person to qualify for your mortgage and your other party doesn't want to be on hook for the mortgage, can you use a blind trust to avoid some of the pitfalls of joint and several?
If you don't tell me about it, you could. So the changing the beneficial ownership of a property is technically a violation of our mortgage terms. So people do it all the time. We don't really have a way of necessarily knowing it. It's basically a letter in a drawer somewhere. But yeah, it's not necessarily for, and sometimes it's for other people. A lot of times when we see it, it is people that are getting personal mortgages on residential property, and then they assign the beneficial ownership to that of a corporation or like a holdco or what have you. And so it becomes a little murky in there. So it's not something that we love to play with. But Tyler, you can probably speak to that.
Perfect. I was waiting for that law, Brian. So no, it comes down to money laundering. So the banks are very concerned about money laundering. They want to know who owns it and who are the contributing people financially to a property, so they know where the money comes from. Money laundering is a really hot topic right now, with a lot of money laundering findings in especially in the Vancouver real estate market, of laundered money coming in and really pushing up real estate prices. There are lenders who will accept property being held in trust. They'd want to see a copy of the trust agreement, have an understanding. They would still underwrite the file to understand who's contributing and who the beneficial owners are, but they would allow the registration to be in a true ownership. So, for example, you have two parties, they'd register it in the name of the true ownership. They'd want to understand. There's now a Bear Trust registry in BC. If you're holding property, you have to declare who the beneficial ownership is. Why would you have a beneficial ownership? One that we see commonly is children with disabilities, parents wanting to own a piece of property, and they qualify in their name, they make their money, but they're not going to live in the asset. So they want to hold it in trust for a child that maybe has developmental or physical disabilities that prevents them from qualifying on their own. But what it would allow is the CRA recognizes the beneficial owner as the person who would pay the capital gains tax when the property is ultimately sold. So by holding it in trust for a child or for a spouse or for some other reason, that person is, if they're living in the property, then when it gets sold, it would be capital gains exempt, and allows the parent to qualify to make the mortgage payments, to deal with the financial end, but the taxation of the property to follow the beneficial owner of the property.
And Tyler, we see it in co-ownership, for example, when you have, let's say, a senior who doesn't need a mortgage on their portion of a property, partnering up with a younger couple or family, and they're willing to, let's say, sell a share in their property to these people, but they don't want to be on the hook for their mortgage. So they might choose to sell the entire property on paper, transfer title entirely, but stay on as a 50% beneficial owner, and contractually have a co-ownership agreement to protect themselves, so that they would avoid the liability for the registered owner's mortgage.
Mm-hmm. Yeah, that structure is one that would take some work on our end to run by lenders to find the right appetite, because every one of those situations is different. They'd want to make sure there was no senior abuse or anything like that involved in the transaction. Ultimately, they'd probably want to pair it up with some sort of also registered charge on title, because when you give away true ownership of the property, transactions can happen because you're not a title holder. It wouldn't prevent someone from putting financing on in excess of the equity in the property. So your guidance is really helpful on that, in terms of working with someone like Coho BC to get that type of guidance, because you guys know how to structure those in advance, what tips to give, and really accelerate those conversations in the right way.
Fantastic. And while you're on that similar topic, so if it can financing work in combination with such a charge? It sounds like it can. And can financing work in combination with a vendor take back mortgage? So if you're going to get half the mortgage from the bank, and then the other owner is going to help finance your other share in the property, can these things work together?
So this is probably a good lob for me again, Ryan. So yes and no. So in residential financing, a bank cannot be part of a financing transaction that exceeds 80% of the value of the property without default insurance. So if there's a charge or borrowed or lent money from a non-owner of the property, or vendor financing or mortgage debt registered, then it would be a prohibited transaction. Now, if vendor financing is under 80% of the value of the property, then yes, it can be done without CMHC and default insurance. And there are lenders who we have seen it work with. When I worked at CIBC Bank, we did permit something like parents. They weren't gifting, they were loaning money with no payment terms. We get a copy of the loan agreement. of say $200,000 that was considered a loan. And maybe they were loaning it in for the purchase of a home with a spouse with a tenuous relationship, and they wanted to protect their investment, but they didn't necessarily want repayment on it. As long as they knew the terms and it fit within the regulations of the bank, it could be pre-approved, and that mortgage charge allowed as secondary financing. But most banks in their standard mortgage documentations prohibit secondary financing and specifically say your mortgage will be placed in default. So you'd want to make sure that you don't do that without prior consultation with your legal team and having strong knowledge of that bank's policies.
Yeah, and I'll just jump onto that as well. We will consider vendor takebacks in certain situations. We really have to understand the situation, and and to actually get a loan agreement, and yeah, again, just kind of understand it. But it's something that can be considered. It's not terribly common, but yeah, it's something that has been done.
Yeah, I would say that vendor financing can be replacement debt, not replacement down payment. You still need a down payment to make up the required amount of equity in a property, but a vendor take back could be replacement debt at a lower rate or a lower cost that could be entertained by financial institutions.
And again, thinking as a co-owner, if the vendor is staying on as a 20% owner in the property, then their equity would count towards that. Yes. And then they could sell the other 80%, partially vendor financed and partially bank or credit union financed, correct?
Yes, that would be a situation that would be workable for sure.
Again, the beauty of co-ownership, to make housing happen that couldn't otherwise happen. So I've changed the security settings. If people have questions, they can raise their hand and we can, unmute themselves and ask their questions directly. You can also throw them into the chat. I could go all night. I got a bunch more, but I'd love to hear what's there in our audience today.
Yeah, I wouldn't mind throwing one at Tyler here because what Ryan was saying that this 4 homes on one lot is going to change the landscape, and I 100% agree. It's happening, and Tyler is very much involved in that. And so maybe Tyler, you can just share how somebody that's got a large lot or a home that's maybe situated on one side is thinking about building a duplex or putting 4 homes on that property. You do a development feasibility study at a reasonable cost. So I'll just lob that to you.
Thanks, David. Yes, if someone's looking to develop their property or curious about what the potential is of their land, unfortunately, the municipalities and the government have made it quite complicated to find out what you can do. So we've put together a package for people to study and understand land use at a reasonable price. So our price is $3,500, and we do a 40-page review and report on your property, where we go through all of the zoning, we go through all of the precedent in the area, something that the municipalities refer to as OCP, or the official community plan of your area. And we go through all the land use options, as well as any prohibitive covenants, any restrictions on your title, to really let you know what all you can build on it. And then we model out 4 or 5 options on every lot to say, here's some different layouts. We would do that if it's a co-housing group and they wanted to know, hey, we have a home and we want to tear it down and build 4. What could we build and what would be feasible? We do a full study on that in terms of what the maximum size would be, maybe what the optimal size, what would be financeable, because it's not as simple as putting the maximum building on any lot. So we study that. If someone was wanting to, say, develop their property and they could put 4 units, should they only build 3? We look at all of those things kind of modeled after it. For the most part, we work with small scale developers as well and professional builders who want to work together. And something that's really coming up that we're seeing more and more is an existing homeowner who's got a fair amount of equity and they're looking towards their retirement years and maybe looking at developing their property, and they might not have quite enough capital or money, or looking at co-ownership or co-development opportunities with others. But once you understand all the potential in your property, then we can look at, what type of putting you together with maybe a builder who had the experience and a little bit of capital, and you have the equity in your property. Here's an example of some things that you can build that we've designed. So right here, these are development permit applications that we've submitted. So this is a sixplex on a single. This is a 5,300 square foot lot that we've submitted for development permit, that you can put 2 1-bedroom units. And then this one has 4 3-bedroom units on each corner. This fits in the city of Victoria on under a 6,000 square foot lot. This is an SSMUH application. This is 2 side-by-side duplexes. These units, you're able to fit a 2-car garage on each one, a flex suite or a 4th bedroom, living room, dining room, pantry, powder room, and then 3 full bedrooms. So on one piece of land, this is about an 8,000 square foot corner lot. You can fit 12 to 16 bedrooms across. This is a row 4-plex that can fit on a single 6,000 square foot lot. And all of those things are possibilities on land now within the new provincial government regulations and then the different municipalities. But there's quite a bit of difference. Understanding what you can fit comes down to the trees, any big rock outcrops for cost. It could come into the setbacks in your municipality, any underground water, and there's a bunch of things that we would just study to make sure that before you take any costly steps that you really understand what's possible on the property.
Fantastic, thank you. A bit of a shift, but I know one of the big advantages, or one of the things I really like about the Vancity mixer mortgage product, and Ryan, I'll have you talk about this, and then Tyler talk about some of the alternatives, is the ability to sell your share down the road and put a new person on as in assuming existing mortgages, getting an additional tranche if necessary, and not having to disturb the remaining party who's not selling their share and forcing them to cancel their mortgage and start again, and all new complexities. Ryan, can you talk a little bit about what happens when one party wants to transfer their ownership stake to a third party and how that system works? And Tyler, if you have any insights on how other institutions might deal with a situation like that.
Yeah, no, absolutely. That's a good thing to bring up. We really try to be as fair as possible. So, in an example where there are, 2 mortgage terms, and one partner is exiting, another one's coming in, the remaining partner can keep, their quote unquote mortgage term. Again, we have to kind of qualify everyone again, but the actual mortgage term itself can remain. There would be no penalties through it, or what have you. We can also, let's say the mortgage being taken over isn't sufficient enough and they need to add funds, we'll mathematically blend that together with the new funds, and again, we'll charge a penalty there. So although again, it does, it is, more complicated, having people, exit and enter and exit. We don't make people start a new mortgage, pay penalties or anything like that.
Thank you. Tyler, any insights on this model?
I would say that it would depend on the lender because each lender's got slightly different rules, but it's called a release of covenant application. So you can maintain your mortgage. So if someone wants to be removed and released, or a replacement covenant is the technical term at the bank, where you're replacing one of the borrowers. So you could theoretically, let's say it was one mortgage facility that was co-owned and there was a back-end calculation of the proportionate use. You could remove one borrower and add a new one. That's something we commonly do. Like in a co-owned within a family, they may not have separate mortgages. with the products at the lenders that do allow them separated outside of Vancity. Again, it would be a release of covenant application. A new borrower comes in, shows what they qualify for, and they can take over the position. And you can blend and increase the debt. Often what happens, though, is I would really suggest they meet with you and your team ahead of time to get some terms in there about these types of exits, because maybe it's beneficial to pay a penalty, and who's going to be on the hook for paying any penalties with canceling that transaction, because new financing with a new borrower might end up being something that's better outside of the mixer mortgage, which really has that benefit that each borrower is picking that term that was right fit for them. But each of these situations is something to really consider. And the more we talk about it before the transaction happens, the better. And that's where groups really should be coming to the experts in you guys and not doing and attempting this on their own. You guys are so far advanced, have all of these templates and conversations that you're going to be able to bring that to the forefront.
Thank you, and thank you. We have a question here from Mona. Could you please share how a co-ownership mortgage would work on bare agricultural or rural land, and generally how much money is required to purchase bare land?
I can start with that one. So it really depends on the land itself and where the geographic location is, if it's serviced. There's a lot of things that go into it. We will go up to 65% of land value. We'll mortgage up to 65% of it. If it's very rural, and again, we like Tyler has access to lenders that are all over the place. We are primarily in the Lower Mainland and onto Vancouver Island. So it really depends where it is, but up to 65%.
And there's a follow-up question here. Does it change if it has a small cabin on it? Does that then become traditional lending?
I mean, if it is a livable dwelling that includes a full kitchen and bathroom, then would potentially conform to zoning, then yes, that counts as a dwelling, and we would potentially be able to go up to 80%. And if CMHC could insure it, then we can, go up to 95%. So it really depends on the specific situation, but yeah.
I would answer by saying if it didn't fit the lending criteria, we would probably create something that would through a purchase plus improvements or a construction loan and say, why don't we make the home fit the financing that you want instead of necessarily finding the financing for the land? But there is some restrictions on agricultural land, forbearance rules, if there is active farming on it. So there's a lot more of a conversation. I enjoy these types of conversations. So kind of the use of the land, if it's going to be actively farmed by a group of people, it may want to be owned in a corporate structure so that the shares could be more split up. There are also commercial financing specifically for farms, Farm Credit Canada and other assets that take security over things beyond the land. They take security over the agricultural crops. They take security over barns and outbuildings and things like that. So looking at this, it would really depend on what you're wanting to use the land for to pair it up with the right type of financing. CIBC has a program where they'll lend on a primary residence in up to 250 acres. And you could own a portion of that in a holdco and have multiple shares within that. They do want the dwelling needs to be a minimum of 1,000 square feet, have permanent heating, and be fully self-contained. But I've helped people in the past who are looking at raw agricultural land of 200 acres. And what we did was, both from an insurance and ownership perspective, we just flipped it to a construction mortgage and built the 1,000 square feet. Ignored the small cottage that was on there, put 1,000 square feet on there to get optimal, cheaper financing. And they were able to get 80% of the purchase price and 80% of the land financed up front instead of needing 35% down. But it really depends on the land itself. There's a really long question that came in.
Yeah, so I'm going to take this moment, noticing that it's now 8:30, to just do a quick wrap up, and then if Tyler and Ryan, if you can stick around for a few minutes to address some follow-up questions like Catherine's, that would be delightful. So just a quick closing about kind of what's happening at Coho. So clearly every situation is unique, and that's one of the beauties of the kind of work that we get to do here. We're working in really unique models of uh, of real estate. So we've been doing some really diverse stuff around selling shares in property, hence some of my questions. Purchasing homes with multiple suites, purchasing homes for collective living, purchasing homes with multiple homes on the property, groups as small as two and groups as large as 12, and places like the Horseshoe Bay Cottages, even just utilizing the existing co-op structures that are there, buying multiple people into a building. So just trying to look at all the different creative ways that we can do this. So if you're looking at your housing needs, definitely reach out to your Coho Pro in your area and start exploring, what are the pathways that would work for you. We have some interesting properties that members of uh, our network are selling now. I'm selling a half a home in East Vancouver on Turner Street. It's actually a three-suited home, so you get to live in one suite and have rental income from the basement. And we're looking for a good partner to help join that situation. Scott is working with an amazing property in the Kootenays that is a 6,000 square foot home on an 18-acre unzoned piece of land. So great potential for collective living in the main house, and a bunch and tiny homes and other kind of outdwellings around the property. So trying to put together a group to take on that property right now. We're working with Catherine, who's the big question. If you stick around to hear her story after this, really interesting stuff that she's working on. So really, please, there's some interesting stuff happening. If you're looking for a housing partner, fill out our partner survey. Let's create a classified about you, respond to the classifieds that exist, talk to our local expert in the area to help find you a partner. And we have some real momentum happening in places like Vancouver, the Sunshine Coast, Victoria, the Vancouver Island, Gabriola Island, where we have an event next week, the Okanagan, the Kootenays. So, most of the province, if you don't see your area listed, well, talk to us and we'll try to get some momentum happening in your region. There are a lot of resources on our website. Ryan mentioned them earlier. Our guide to property co-ownership being a great place to start, our YouTube channel, and then resources like the document that Ryan showed us earlier that you can get off of the Vancity site or off of our site as well. So do check out cohobc.com. And we have a huge lineup of upcoming events in person and online. In-person events on Gabriola Island next week, in East Vancouver in a couple of weeks, on the Sunshine Coast in about a month and a half, and online events like on March 31st, our co-building multiplexes event, where we'll go into much more detail. Tyler will be joining us again, and we'll go, as long as some other builders, and we'll be going into much more detail about what that looks like. So plan to come to that. Plan to come to our event in April on selling a portion of your property, if that's something that makes sense for yourself. And then our matchmaking event on May 6th. To follow up, please take down Ryan and Tyler's information, or feel free to reach out to us to get their information if you can't grab it in time. Take a photo. That's always a quick way to just grab it and jot it down later. So definitely follow up with them to look at your financing options, and follow up with myself, Brian, David, and Scott, the Coho affiliated agent in your area, to think about your situation, what your housing needs are, and what's possible. As we said, the real estate agents and the financiers are your first line, right? We need to talk to us to find out what you can get and what are your options and how can you think creatively, and you got to talk to them to figure out what you can afford and whether those things align. And so we're all here to get you going from the beginning. So really a big thank you to everyone who came today. And of course, a biggest thank you to Tyler and Ryan for spending their evening with us and helping us learn all the intricacies of financing co-owned property. Like so many things in co-ownership, it all comes down to almost anything is possible. Just have to get the right professionals, the right vision, and the right systems, social, legal, financial, and real estate, of course, in place to make this happen. So we're delighted to work with you to make your visions happen. But Ryan and Tyler, thank you guys so much. We really appreciate your time. This video will be shared with everyone who's here. Feel free to forward it on to others who you think should see it, and will be available on our YouTube channel going forward. So thank you for everyone who's here.